What happens when a stock market bubble bursts? I ask the question for a glaringly obvious reason, which is that global stock markets are at the moment at record highs. Whether it be the FTSE 100 in the UK or the S&P 500 in the USA or any other market you want to look at anywhere else in the world, tech and AI have driven valuations of shares into the stratosphere. And everyone knows it's a bubble. No one is pretending otherwise. Every serious investor knows what they're doing, but none of them appear to dare to leave the dance at present, desperate to secure the last ounce of value before they think they will know when to leave, when in practice they won't.
Imagine waking up one morning to find that the stock market, once booming, once unstoppable, has suddenly collapsed. Trillions vanish overnight. Retirement accounts evaporate. Giants of industry crumble. And the same commentators who spent months saying, "Everything is fine," now claim they saw it coming. It's a pattern older than the markets themselves. A cycle that stretches across centuries. And it always begins the same way, with absolute confidence right before the fall. Today, we're diving deep inside the stock market bubble, what creates it, why people never seem to spot it in time, and the unmistakable lessons history keeps trying to teach us, but we never learn. The seduction of easy wealth. Every bubble in history begins with a whisper. That whisper spreads into excitement, and excitement turns into a fever. People begin believing that wealth can be created out of thin air. Suddenly, the old rules don't seem to apply anymore. Everyone, your neighbors, your friends, your coworkers, believes they've found the secret that the rest of the world missed. The stock market becomes a magical machine. Push in $1 and get back 2, then 4, then 10. And no one asks if this makes sense. Why? Because the profits feel real. Because the screens show everything going up. Because everyone else is doing it. Humans have always been attracted to the idea of effortless gain. It's the same reason gambling keeps casinos alive. It's the same reason people fall for schemes. And it's the fuel that ignites every stock market bubble. When the promise of easy riches appears, logic dies first. History shows that even the smartest people can become blind when greed begins to whisper. This is how bubbles form, not through charts, not through economic theory, but through human psychology. The desire to belong, the fear of missing out, the belief that, this time, things are different. Every bubble begins when society collectively convinces itself that a shortcut to wealth exists. The birth of irrational confidence. Once the excitement takes hold, something strange happens. People begin rewriting reality. Suddenly, outrageous stock valuations are justified. Risky companies with no profits are treated like the next revolution. Everyone becomes an expert, predicting the future with absolute certainty. In the late stages of a bubble, confidence becomes irrational. People don't talk about if things will grow, they talk about how fast. No number seems too high. No investment seems too dangerous. People stop asking questions. The market becomes a place where doubt is an enemy and skepticism is a sin. And when confidence spreads, institutions join in. Banks loosen lending. Analysts produce glowing forecasts. Media outlets hype every success story. Every headline reinforces one message: the market can only go up. This is exactly when the danger is greatest, because the further prices rise beyond reality, the harder the crash that follows. But in the middle of a bubble, warning signs don't matter. People laugh at caution. They call skeptics negative, outdated, or jealous. Bubbles thrive on overconfidence, and at the peak, the world becomes drunk on it. History's warnings, echoes of previous crashes. To understand today's market, we must look at the past, because bubbles rarely invent new stories. They repeat them. The characters change, the industries change, the technology changes, but the structure stays the same. Decades ago, it was the dot-com bubble. Before that, the Japanese asset bubble. Before that, the Great Depression. Before that, the railroads. Before that, even the South Sea bubble of the 1700s. And every single one had the same ingredients: surging prices, unrealistic expectations, excessive borrowing, and a belief that the old rules no longer apply. During the dot-com era, Companies with no revenue were valued higher than multinational corporations. Investors said, "The internet changes everything." They were right, just not in the way they imagined. Most of those companies disappeared, fortunes evaporated, and people who thought they were geniuses found themselves broke. In Japan, land prices became so inflated that a small patch of Tokyo was said to be worth more than all the land in California. Banks fed the frenzy with easy loans. When it crashed, Japan entered decades of stagnation that scarred the economy permanently. The Great Depression, same pattern. A decade of booming stocks, easy credit, widespread speculation, and a culture convinced that prosperity was guaranteed. Markets crash for many reasons, but they form for one: we forget the past. Each generation believes it's smarter than the last, that they've unlocked something new, that history is old data, not a warning. Yet history keeps repeating itself again and again because human nature never changes. The anatomy of a bubble's peak. Every bubble eventually reaches a moment of peak madness. It is the exact point where reality and fantasy part ways completely. Prices become detached from fundamentals. Rumors move the market more than profits. Meme stocks, hype-driven assets, and speculative bets take the spotlight. During the peak, the atmosphere feels invincible. People brag about their investment wins. Stories of overnight millionaires spread everywhere. And often, it's the everyday investor, the last one to the party, who rushes in with full confidence. This is the point where the market becomes a pressure cooker. A single spark can start the collapse. It doesn't need a big trigger. It can be a small earnings miss, a rumor, a rate hike, a policy change, even a bad headline. Because at this height, the market is built on emotion, not substance. And when that spark comes, everything changes. Confidence disappears. The same people who said, "Never sell," suddenly panic. Investors run for the exits. Prices fall faster than they rose. Fear replaces greed, and the bubble bursts not slowly, but violently. This is the phase when fortunes vanish. When companies that once seemed unstoppable crash back to earth. When banks, funds, and businesses realize they were overexposed. And when society finally wakes up to reality. The domino effect. Why crashes spread everywhere. What makes stock market bubbles so dangerous isn't just the initial crash, it's the chain reaction that follows. When the bubble pops, margin calls hit investors. Companies cut spending. Loans become harder to get. Consumers stop buying. Confidence evaporates from every corner of the economy. The stock market might be the first domino, but it never falls alone. Businesses reduce their workforce. Governments scramble to stabilize markets. Banks tighten credit. Millions of people who never invested in stocks feel the impact. Bubbles don't just destroy wealth, they reshape societies. Every major crash has created winners and losers, but the losers always outnumber the winners. For every investor who cleverly exited before the fall, thousands were caught in the collapse. Stock market bubbles are not just financial events, they are human tragedies. They destroy dreams, savings, and futures. And yet, even after all this pain, the cycle eventually restarts. New industries rise. New excitement builds. New promises of easy wealth emerge. And slowly, the bubble begins forming again, because humans are wired to forget what history teaches and why we ignore it. So what does history actually teach us about stock market bubbles? It teaches us that markets are not driven by numbers, they're driven by people. Fear and greed shape the world more than charts ever will. It teaches us that the signs of a bubble are always visible, but people choose to ignore them. Signs like overvaluation, extreme optimism, widespread speculation, skyrocketing debt, and a belief that things will rise forever. It teaches us that bubbles are inevitable because every generation makes the same mistakes. People chase fast money. They mistake luck for skill. They invest emotionally instead of logically. But most importantly, history teaches us this. Every bubble ends, no matter how big, no matter how unstoppable it seems. Markets always return to fundamentals eventually. Reality always wins, and the people who understand this aren't the most brilliant analysts, they're the ones who stay calm while everyone else chases illusions. Preparing for the next bubble because another is always coming. There will be another bubble. That is guaranteed. It might be in tech. It might be in real estate. It might be in AI, crypto, green energy, biotech, no one knows. But the pattern will be the same. The real question is, what will you do when it comes? Those who survive bubbles don't try to time the exact peak. They don't follow the crowd. They don't believe hype. They don't invest emotionally. They look at fundamentals, not fantasies. They protect their capital instead of betting it all. The smartest investors in history aren't the ones who made the biggest gains, they're the ones who avoided the biggest losses. Because in a bubble, survival is the real victory. If you want to learn from the past, learn this. Never let excitement replace judgment. Never let hype replace reality. And never forget that when everyone believes you can't lose, that is exactly when danger is highest. Stock market bubbles are not accidents. They are crafted by human hands built from greed, fueled by confidence, and destroyed by fear. History keeps warning us, again and again, but the world keeps forgetting. But you don't have to. You can choose to see the signs others ignore. You can choose patience over panic. You can choose discipline over hype. And when the next bubble shows up, and it will, you can choose not to become one of its victims. Because in the end, markets don't reward the loudest voices or the most confident predictions. They reward the people who understand that wealth built slowly lasts, and wealth built on illusion always disappears.